Good day and welcome to Godrej Consumer Products Limited Q1 FY2024 earnings call. As a reminder, all participant lines will listen mode. There will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference, signal an operator by pressing star then 0 on your personal phone. Please note, the conference is being recorded. I now hand the conference over to management. Thank you and over to you.
Thank you, Aman. Good evening, everyone, and thank you for joining us today late evening to discuss the performance of Q1 FY24. We have with us Nisha Godrej, Executive Chairperson, Sudhir Sitapati, Managing Director and CEO, and Anil Shah, CFO from PCPL's management team. Without taking much time, I will hand it over to Sudhir for his opening remarks, and then we'll be happy to take any questions.
Thanks, Tapan. Good evening to all of you. Despite the tough market conditions, our performance in Q1 FY24 was ahead of our expectations on both volume and profit growth. At a consolidated level, including inorganic, UVG was 10%, constant currency sales growth was 15%, INR sales growth was 10%, EBITDA was 28%, and PAT without exceptional was 19%. Operating cash flow was up 4.9x, albeit on a weak editor. Technically, UVG was 8%, constant currency sales growth was 13%, INR growth was 9%. Working media was up 68%, and EBITDA was up around 36%. Our USG was impacted due to price deflation in soaps and the currency translation impact in Nigeria. PAT was behind EBITDA due to higher forex losses and match credit utilization. This is a non-cash item as our growth in operating cash flow shows. Our working capital reduction across the board continues to be significant, resulting in exceptional operating cash flow. If one compares these numbers with Q1 FY20, a pre-COVID quarter, our reported EBITDA is roughly the same with a very different shape of P&L. Our GMs are down 350 bips and our ATL is up 100 BPS. Both these are investments into things that consumers see. Our BTL and overheads are down by a corresponding 450 bips. We think our underlying volume trajectory, while not yet double digit, has significantly improved because of the shape of P&L. Organically, India had a strong quarter with 10% UVG, 6% USG, and around 30% EBITDA growth. Market conditions are tough, and our good performance has been due to a soft competitor on soap volumes, a good HI season in the north, and our market development investments. Indonesia had a strong quarter despite another round of downstocking in modern trade. Volume was up 12%, 15% constant currency growth, 20% sales growth, 53% EBITDA growth. Stocks in modern trade are now down from a peak of 95 days to around 58 days. Along with generally strong macros, augurs well for the future of the business. Warm also had a good quarter with 3% volume, 16% currency growth, 9% sales growth, and 55% EBITDA growth. These numbers have been affected marginally by the devaluation in Nigeria in the last fortnight of June. The impact of the Nigeria devaluation will be significant optically over the next few quarters, so it merits some understanding. A23, the official market rate was 450 Naira to a dollar, while the parallel market rate was 750 Naira to a dollar. We were buying dollars at a weighted average cost of Naira 650 to the dollar. The delta between official rate and parallel market rate was reflected in a forex loss line. This accounting translation was happening at an official rate of Naira 450 to the dollar. With the free float, the Naira is now around 750 to the dollar and it may depreciate further. But what we will do is to pass on price increase to end consumers for Naira 650 to a dollar to 750 to a dollar such that our profits are intact. However, we will have to read EBITDA plus forex loss line item together for the next 4 quarters as the forex loss will move to material costs from Q2 onwards. The earlier guidance on profitability remains intact. Secondly, there will be accounting translation impact from Naira 450 to Naira 750, which will get partly offset by the 650 to 750 Naira increase. However, the balance will affect INR sales growth by about 200 BPS at consolidated level. Please note that there will be no impact on volumes or constant currency growth here. So between 450 and 650, we will not price, and it will be an accounting hit. 650 onwards, we will price for. This, while in the short term makes reading our results a little bit more difficult, in the long term, we believe that it strengthens our competitiveness, as all players will have to now buy at the free-floating rate of 750 Naira to $1. And hence, we think there will be an opportunity to gain market share. LATAM also had a good quarter with 12% volume growth. Let me now share the progress we have made on our strategy, which I had detailed out in our annual analyst meet a few months back. We remain committed to our strategy of category development, simplification, and sustainability. On category development, we have been consistently investing in our brands, with our media investments in India increasing by 125% year on year. We have launched an innovative membrane-based air freshener called Aero in the car segment. Lastly, we are also planning to invest around 900 crores in organic manufacturing capex in India over the next 18 to 36 months, largely for volume growth, but also for logistics reasons. On simplification, our partnership with the national distribution in Nigeria is progressing well, and we expect to see the benefits of this as the year progresses. In Indonesia, we have reduced stocks in modern trade from, as I mentioned before, 95 days to around 58 days. Lastly, on people and planet, alongside Profit Front, we have recently pilot launched Magic Floor Cleaner, which is an environment-friendly powder-to-liquid-based format, playing in the large and fast-growing floor cleaning space. The understanding of the financial performance of GCPL in FY24 is complex due to several factors. The optical evaluation of Nigeria, the inorganic impact of the RCCL acquisition, and the MAT credit we will avail in FY24 and 25. We therefore believe that the four primary metrics to look at while evaluating our performance are organic UPG, organic constant currency growth, EBITDA including forests, and operating cash flow, which are largely unaffected by the above. Despite market conditions, especially in India being tough, we remain optimistic of our full year ambitions, including on Park Avenue and Kama Sutra. Thank you.
Should we open the line for Q&A?
Yes, sir.
Right. Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and one on the touchtone telephone. If you wish to remove yourself from the question queue, you may press star and two. Participants are required to use for asking a question. Ladies and gentlemen, for a moment while the question queue samples. The first question is from the line of Manish Roy from Nuvama Institutional Equities. Please go ahead.
Yeah, thanks, and congrats on good results. My first question is on 900 crore capex. We have seen food companies do a lot of insourcing versus outsourcing. On one hand, it's like a decade ritual, and gradually outsourcing. Want to understand why we not outsourcing in this, and what is the long-term issue we are looking at of the insourcing versus outsourcing?
Thanks, Abneesh. Look, while evaluating insourcing and outsourcing, there are three criteria. One is the scale within the industry. And in most of the categories that we operate in, we have a pretty and high scale within the industry. So when you have high scale, when you have low scale, it makes sense to take the benefit of the scale of the third-party supplier. When you have high scale, it makes sense to do it yourself. Second is really how commoditized or differentiated the categories are. Many of our categories we feel are differentiated with enough secret sauce and high margins that merit us doing it ourselves. Soaps is maybe an exception here, but it's not an exception to the rule of scale, and most people manufacture soap scale by themselves. The third thing is capability. If you have capability like we do in India, one should do it oneself. And finally is how automated or labor intensive the process is. The more labor intensive, sometimes it's better to outsource. But the way we see a lot of our businesses is that the production will be pretty automated. So for a combination of these four reasons, we feel that a lot of our growth and logistics related savings needs to come from insourcing. Of course, this doesn't mean that we will completely stop outsourcing. For instance, our coil business in household insecticide doesn't really meet any of these criteria or doesn't meet most of these criteria, and so we will continue to outsource it. I suspect, I don't know the exact number, Abneesh, on what it will be, but I suspect that the majority of our business will be insourced.
Great, thanks, sir. My second question is on the massive simplification, SKU rationalization and inventory reduction you have done, especially in India and Indonesia. My question is, why was ECL not doing it earlier? So how to impact your business of consumers getting more choice? Because now lesser SKU, lesser inventory. From the customer choice, obviously it will be lower. In terms of, say, market share overall, I understand there's a lot of tail. I wanted to get clarity why it was not earlier.
I think the defined focus of our business has been on category development, and category development needs a few. You're convincing consumers to enter categories. So the moment our focus is on category or market development, you realize that very few SKUs are required to catalyze the category development. So the SKU reduction and simplification has been because of a re-emphasis on category development, which has certainly been, I won't say it's a new strategy, I think we always had it, but certainly it has been re-emphasized. It does not have an impact on market shares, Abneesh. If anything, the market shares in general for us are very good, both in India and Indonesia. And when we simplify our SKUs, what tends to happen is core SKUs tend to have better availability in shelves because tail SKUs don't block killer capital, and market shares tend to go up, as have been happening for us.
So last question, we have seen in segments where commodity inflation has trend, regional prices come back, so biscuits, detergents, etc., even in soap. So how are you retaliating? Because your growth rate, of course, the base was a bit off. But going ahead, to see that regional prices back, so you need to pass on customer. So overall, you could say many times that demand scenario in India means is not challenging. So that context, how?
I think there are two things here, Abneesh. The soaps category, compared to, let's say, 10 or 15 years ago, doesn't have the same salience of local players as some other categories do, or indeed soaps did a decade or 2 decades ago. It's now a pretty consolidated category. Not that there are no local players, but that is not the major salience in the soaps category. Our general principle on pricing is, in inflationary times, to absorb inflation to the extent that we can and protect consumers. And when prices fall, not to kind of make excess profit from those margins. So our margins in soaps at a gross margin levels have not crossed our historic levels. And we have been quick off the block in passing soaps, so passing prices. So we are less, we've been speaking of this. Our real goal is volume growth. And we are not that, fast. As long as volume growth is good and operating cash flow is good, we're not really worrying all that much about sales growth. And we have been, certainly we have passed on prices commensurate with the margins we think we should earn in this category.
So thanks, that's all from me. Thank you.
The next question is from the line of Avi from Macquarie. Please go ahead.
Hi, Sudhir. Thanks for the opportunity. I wanted to kind of just focus, on payments portfolio. Now, this quarter we have seen almost a 45 crore loss in this business. A, want to understand what drove that sharp sales is almost similar to that. And B, give your thoughts. We've retained guidance of margin for the year. So how do you see this changing, as we move into the quarters of FY2023?
So I think our Raymond's acquisition so far has been quite good. It has been on plan, and We are quite happy with the progress in the integration. The reason for the GSV gross sales value number in the 1.5 months that we bought it has roughly been the average, despite downstocking at the primary point, which is a distributor. We have had two reasons for a lower NSV sales and low profits. One is take back of slow moving inventory, which we had planned to do so that we can get distributor capital to move faster. And secondly, from the day we have taken over the business, we have started investing in ATL because we believe this is a category that ATL will drive business. So these are the two reasons that we have reported the loss that we have and reported a sales growth which is significantly lower than the gross sales value growth. We maintained broadly what we said we'll do for the year, which was not single-digit UVG. It was roughly the single-digit
margin. I was bigger margin.
Yeah. So I think we remain committed to doing what we've done in year one because we want to just clean out a lot of stuff. And by the end of this year and certainly next year, our goal is to get to being EPS positive. And there's nothing that has happened so far in the business that leads us to believe that our strategy is, there'll be no surprises in the business so far.
And just to add, in quarter one, we didn't have overhead synergies, which would start getting cleared up from quarter two onwards. And hence, we remain still confident of, getting close to the ambition of high single-digit EBITDA margins on a clear basis.
So the way it should be is this loss should no longer, it should kind of improve, which from a profit and then kind of reach towards that trajectory for the full year. That's the way I should. The hard work is more or less behind us in 1Q, and that is largely.
Q2 will still be a quarter that we will see in Q2. There will be things that we are doing to synergize. So, it may not be as like Q1, but it will still not be life as normal. We hope Q3 and then Q4. We hope things improve. We are currently quite confident of that, Avi. So and our general thing has been, the investments upfront, take the pain early, and be patient in the results. And we've seen it category after category that's played out, and we see no reason why it shouldn't play out here.
Hope that clarifies. And or just as clarification, the palm oil prices. Would love to hear your outlook on how you see that kind of trending. And whether there is, as of now, any reason to revisit pricing. Talk to my side.
Yeah, palm oil prices in the recent past have again sort of strengthened a little bit, but nothing out of the extraordinary. I think we will, in normal times, we will prudently pass on kind of reasonable costs to the consumer. If it's hyperinflationary, then things are there, but that's not what palm is looking like right now. It's looking slightly inflationary compared to where it is today, but still significantly lower than what it was last year.
Perfect, Sudhir. That clarifies. Thank you very much.
The next question is from the line of Vivek M. from Jefferies. Please go ahead.
Hi, Sudhir and team. A few questions. First on CapEx again. So this CapEx 900 crores, I don't know when did we last see this kind of bunch of CapEx. Just to clarify, when you say that it adds 20% to your capacity, that's the theoretical capacity or the real capacity. What I mean is that basically, is it because of you want to augment capacity, or some of this is actually replacing the existing ones? Let's say because of technology reasons or let's say better logistics.
See, there are three things we want to do, Vivek. Number one is we are bullish on volume growth. We're seeing it, and we have to now plan for volume growth. Number two is we believe that significantly, and we had mentioned this in our strategy, that we have to move money from working capital to automation. So we believe that our supply chain needs better automation or higher degrees of automation in order to increase productivity. That's number two. Number three is that we think that the logistics of our manufacturing needs to change. A lot of our business is down south, and we feel that we need some manufacturing closer to the big markets of south. These are the three reasons. It's 900 crores over 3 years, which is about 300 crores a year in India. We would normally have put 140, 150 crores in our, let's say roughly 150 crores a year in any case for augmenting capacity for this line, that line. So it is an increase of about 450 crores over the next 3 years. We are more than recovering for all this through growth and working capital, and our view on savings and our view on ROCE is very good for this capex.
Okay, got it. The second bit, sorry, Sudhir, you explained, this entire Nigerian. Can you just explain it again in terms of which all line item it's going to hit over the next quarters?
Hey Vivek, this is Samir here. So as Sudhir called out earlier, you'll see around May 23 official rate of Naira to dollar was around 450. Okay? And entire translation was happening at 450 Naira to a dollar and then dollar to rupee. Now what has happened is 450 Naira to a dollar has devalued to say around 750 Naira to a dollar, which means the entire accounting translation, line by line, kind of translation of each of the P&L line items will happen at 750. So that's the cash impact. It's more of, accounting translation impact, which will get reflected in, say, the overall INR sales growth. So that's one accounting translation impact. Second impact is on inflation. So earlier what was happening is we used to buy part of our dollar needs at 450 Naira to a dollar. Part was at whatever, we want to call panel market or blue market rate, say around $700 Naira to a dollar. Ended rate was around 630 Naira to a dollar. Now that 650 will move to say 750, which is the rate at this point in time, which means cost of purchase will increase from 650 Naira to 750 Naira, which we will pass it on to the end consumers. Part of it has already passed on, and part will again get passed on over the next couple of months. That we will take care of it by passing on the prices to end consumers. It may come with a lag of few months, but it will directionally get passed on. So that's the inflationary impact, but it will get mitigated. Third is again more in terms of grouping, regrouping. What was happening technically earlier is the correct line item in the P&L was the delta between purchase at the open market, say 700 Naira to a dollar, reduced by 450 Naira to a dollar. So that will start sitting in the materials cost to gross margin, and hence we should be looking at EBITDA including forex line item for a better comparability in terms of how the trends are sequentially, but more importantly on a YOY basis. These are the three impacts, Vivek, which this Naira devaluation will have eventually on the P&L.
So I think basically, Vivek, the USG will get affected because 450 to 650 we won't price for, because that's just an optical change. 650 to 750 we will price, albeit over the next 2-3 months, so there might be some short-term impact. The second thing is the forex plus EBITDA is what we should look at. So we anticipate about 200 bits of USG reduction on purely this optics, because 650 to 450 is a 30% optics in terms of USG on a business that is 8% of our 7-8% of our revenue. That's about 200 bits on the optics of USG. So that's a optical change. It's not a real change. I don't know if that's clear, Vivek.
Yeah, that is helpful. Although I'm sure we will have some challenge on the modeling, but this is useful. The other point was, Sudhir, on the NT spend. Can you talk about where do you think India and Concall will settle at in FY24? It's good to see a push up in spend, but where does it settle at for both India and international?
I mean, look, I think the India organic business is not very far from competitors, peers, etc. The Raymond's business is still low, so there, on a weighted average basis that may go up, but that's because RCCL is frankly not spending anything on media at all. I think Indonesia probably should go up more. I think it's still low at, 4% now?
4%.
That's still a bit low. Africa has to be disaggregated a little bit. And, the requirements of hair extension are different from FMCG. I would probably say that is also a bit low. So India organic is kind of roughly where it is. The other three parts of our portfolio, RCCL, Guam and Indonesia, I think the confidence, the thing about investment in ATL is it's not just an ideology, right? You got to invest, you got to see it like an India is seeing it, and then you got to do it. But broadly, that's how to go with it.
Okay. And really two very small points. One is on Magic Floor Cleaner. So it doesn't dilute brand Magic, because from a shampoo to from a hand wash, body wash to a floor cleaner, doesn't that dilute the brand?
I think, Vivek, I'll send you the advertisement for Magic hand wash. Maybe just send it to everybody. I think, at the end of the day, Magic is positioned as good for the planet, and basically this idea of reconstitution, that you take one small sachet and reconstitute it into a product. So our thinking has been to keep that as the core of Magic. And what we have seen is that across the world, many brands have positioned themselves pretty strongly on the environment and planet, are able to straddle a few categories in home and personal care. I mean, Ecover is a good example of that in the UK. And therefore, we felt that it was probably better for us to have a single brand in home care and personal care. And Magic is not, frankly, a skin cream. It's a hand wash there and it's a floor cleaner here. Versus getting into different brands, and because the mode of communication, and I asked Tapan to send all of you the new Magic communication, which is on air. We like it quite a lot. We hope you do. But and maybe send the hand wash ad as well. Just send the hand wash and the floor cleaner ad. We think that it makes a reasonably coherent picture. It's obviously something we thought about, but sometimes you've got to just take a call, and this is the call we took with it.
Interesting. And last bit, Sudhir, how big is shampoo hair color as a percentage of overall category right now?
The shampoo hair color is a fast-growing segment. I don't think it will be proper for me to give the exact numbers. It's a fast-growing segment within the hair color market, and we are also growing fast. One of the things that we did last quarter was to launch a 15 rupee shampoo hair color in the south of India, and that has been doing extremely well for us. So just as we launched 15 rupee creme in last year, this quarter we launched a 15 rupee shampoo hair color. We were the pioneers in the market to do so.
But no comments on how it is as a percentage of overall hair color category?
Not specifically, but it's a fast-growing segment, Vivek. It is material and fast-growing, but you'll be able to find out that it's not proper for us to tell you what it is.
Got it. Thank you, Sudhir and team. I wish you all the very best.
Thank you, Vivek.
Thank you. Any participants who wish to ask a question at this time, may please press star and 1. The next question is line of Percy Panthaki from IIFL. Please go ahead.
Hi, Sudhir. Hi, Samir. My question is on household insecticides for India. I'm assuming that home care is 13% growth, so household insecticides will be like somewhere between 8-10% at least, if not more. What I wanted to understand is that what are the drivers for this growth? Of course, you have launched 2 new products, the spray and the vaporizer, both in the small units. So is that the main driver? And now it's been some time, so can you give us some idea on whether you consider these products as successful products internally based on repeat purchases, etc.?
Household insecticide performance has been driven by 2 factors. One is that it has been a relatively sort of weaker summer, and therefore the season extended. So that has been definitely a good contributor to household insecticide. There has been some impact of market development. It's still too early to say how much of it is due to the smaller packs. We are quite encouraged by those results. But, in consonance with heavy advertising, our non-mosquito format has done particularly well. So there's been, I would say, market development investments plus a good season. I still would say that this is not a category where, in all honesty, we can say that this is really at the potential that it should be. It still requires more effort. This has been a good quarter, but I don't think we can call victory yet in this category.
Right. Secondly, on the Raymond's portfolio, just correct me if I'm wrong, but this has consolidated for 1.5 months only and not the quarter. Is that right?
That's right. We took over on May 10th, so really from that onwards, it's 1.5 months roughly is what it's consolidated for.
But still, like a 45 crore sales, isn't that too less, considering that this will be the best quarter out of the 4 for this, and the overall annual sales is like 620 crores. So on a run rate basis also, it's not even meeting last year's sales, right?
Yeah, Percy, I told you, right, there are 2-3 reasons for this. One is, you're right about the fact that the run rate for this business is about 150 crores a quarter, or half a quarter would have been 75 to 80 crores. The downstock distributors here were sitting, and we're going to have to further do it. distributors in this business were sitting at 80 to 90 days of stock. Our distributors in GCPL sit on 10 days of stock. So while we didn't come all the way to 10, we've had to come a pretty large distance in terms of down stocking. Second thing that we have done is we have taken returns, which is negative sales, to large tune. So our GSV is lower than it should have been by a little bit because of the downstocking at the distributor point. Our NSV has been lower than GSV because of stock returns. You must remember that we have done nothing to this business in the last 1.5 months except clean up. Now, as and when we see synergies, etc., we will see these numbers go up. So we remain quite confident that what we are doing, we are investing in media right now. Sooner than later, we will start investing in distribution once, we are able to bring the might of GCPL onto this business. So we don't think that in the context of that, of the downstocking and the returns, 50 crores of NSV for 1.5 months is okay.
So this downstocking and returns, are they now behind us, or this will continue into the next few quarters?
I think returns are probably more or less behind us. Downstocking will have to continue because from 90 days, we are determined to bring this down to 10 days, which is 80 days in general trade, not in modern trade, which is you calculate that, and that we will do because we think there's a lot of cost that gets trapped because of holding this kind of inventory which we want to release. So that will continue in Q2, but I don't think it will continue in Q3 and Q4.
And on a full year basis, at a net sales level, you stick to your guidance of having a flat YOY?
Yes.
Okay. Yeah, that's all for me. Thanks and all the best.
Percy, is the question answered?
Yes.
All right, thank you. The next question is from the line of Jay Doshi from Kotak. Please go ahead.
Hi, thanks for the opportunity. Quick follow-up on the previous question on HI. Now, 2 consecutive quarters of double-digit growth in HI on the base. How should we cover the next 2 quarters? If I remember correctly, September last year and December last year were reasonably for HI with some shift in season. Do you expect this to continue or will
it's hard to predict. I mean, I don't think we were sitting on a weak base by the way of HI. I think last year was sitting on an extremely strong COVID base of HI. So, when we look at 4-year numbers, CAGRs, which is how we look at numbers, we still think the quarter was good, but it's not on a weak base or anything like that. It is a seasonal category. The seasons have moved. So it moves. I mean, it moves in what I've now seen in 2 years is it moves in steps of 2 months. So it isn't, we shouldn't get too excited with 1 or 2 quarters of good results. Similarly, we shouldn't get too affected by 1 or 2 quarters of not so good results. I would say, however, just to repeat this, that we made some progress on HI, but, unlike many of the other categories like Indonesia, many of the categories in India where we feel we're really kind of, on the absolutely there. I think HI, it is still early to declare victory in HI. I still remain, by the way, really confident that in the medium term, this will be a accretive growth driver for GCPL. But the last 2 quarters results shouldn't be read as a premature sign of declaring victory in this category.
That's helpful. And one more on so 15 to 20% is net capacity. Does this sort of factor in that you will be moving some of your outsourced capacity or production to in-house, and over and above that, your outsourced in-house is also increased by 15-20%?
Yes, this factors in the fact that as we increase our capacity, in many of the categories, we are realizing that when we outsource it because of some seasonal demand, etc. We find our manufacturing is more effective. So this includes the volume growth and the insourcing of factories that are currently outsourced.
That's helpful. Thank you so much.
Thank you. The next question is from the line of Sheila Rathi from Morgan Stanley. Please go ahead.
Thanks for taking my question. Just one question from my side, Steve. This is respect the ad spends again. We are at about 12.5% of ad spends for India business and about 9.4% consolidated. Probably we would be the highest FMCG space this quarter from a sales perspective. And on an average is also significantly higher, almost doubling on a year-on-year basis. Do we think we sustain this, and what where we see that kind of spends will be going into, if you could elaborate? And the follow-up on that question itself is that does this incorporate the high teens growth we have called out the strategy meeting last quarter?
I mean, Sheila, 2, 3 questions here, so let me answer it. I think, it's not, there's no right number and also advertising numbers. I mean, I mentioned it earlier that we certainly are on organic India business round about what a business of our profile and our growth profile should have. But look, if there is good return on investment to be had on media, we're not going to stop at a number because it's 12.5. And similarly, if we find some of our business over a few quarters not giving return on investment and we have to scale back, get it back, we won't do it. I mean, we won't hesitate from doing it. So it's not a specific number. I think the important point, Sheila, is to look at what I had read in my note, which is compared to 3 years ago, same quarter, or 4 years ago, same quarter, which was the pre-COVID quarter, our GMs are down and our ATL is up, but our EBITDA is actually greater or equal to what it was, which means there's a fundamental shift, and a volume growth trajectory, while I think 10% does have this element of good HI season, is higher than our volume growth trajectory in the past. So this model is broadly working. We will now, keep calibrating it as we go along. I mean, ultimately, we are investing in ATL to drive volume growth. We'll keep calibrating it up and down. But in India, I would, as I answered, I think, Vivek, the number broadly, roughly seems in the vicinity, but it's not from any other parts of our business.
And on
No, I think we will continue. I think, if volume growth come, we're efficient on costs, and, we're simplifying our business. Volume growth always leads to good EBITDA growth. So there's no such thing as, again, a right EBITDA. There is gross margin is important because gross margin is value to consumers. And sometimes if you cross a value, some kind of threshold on gross margin on existing categories, if it comes because of mix, it's great. It can have impact, but we'll continue growing EBITDA as long as we know volume growths are coming.
Thank you. Next question is from the line of Chandra Arora from ICICI Prudential LIC. Please go ahead.
Hi, good evening. Just a curiosity that whenever we are launching a new SKU at a lower price, like in the hair color and the shampoo and also in the aerosols, how do we calibrate the volumes for the existing SKUs, given that some of the users may shift to this new SKU?
I mean, look, our general view on this in India is in underpenetrated categories. I think there's a question of how penetrated a category is. But in underpenetrated categories, when you launch an access pack, the upgradation that you get is far in excess of whatever downgradation you have. The downgradation that you have tends to be in the first 12 months of the launch, whereas the upgradation that you get tends to be for a much longer period. That's because, those consumers who are value seeking and want to downgrade off in the first year. But there are a lot of consumers who don't want a small pack. I mean, if you think of most of us, we don't necessarily buy the smallest pack, which is the best value per ml. We buy what's convenient. So these are the two trends that we see in India.
Okay.
Thank you. The next question is from the line of Abneesh Roy from Nuvama Institutional Equities. Please go ahead.
Yes, my question is again on HI. You have done these LUPs also, and you have said that still a bit early to celebrate. And what exactly is needed here? Because earlier you have done very disruptive product at 15 rupees, say in the hair dye, or say in HI also you have done, and in terms of the powder to liquid, etc. So here, what is the missing link? Will it be much more efficacious products at much lower price point? Because currently the 35 rupee or the 50 rupee LUP in HI is more of a smaller version of the existing product. It is not more efficacious. That's the missing link?
Yeah, that's probably right, Abneesh. I mean, if you look at some of the molecules that are available in China and which are illegally coming into India through incense sticks is really the carrier of it. These are much cheaper, high efficacy molecules. So there is a lot of, they have not been registered in India, but there is definitely a dimension to the issue.
Right. Second question is on the India business, e-commerce plus modern trade. Probably if I see the FG pack, most companies are in the 20% range. Of course, FY2023 there has been a big growth. So what is the number for you? And in Q1, how has been the growth rate of these two trade channels?
Well, these two trade channels have, like for most companies, outgrown general trade. We don't measure and we don't track salience of these, Avnish. We track availability of our products in modern trade, visibility and ease of search in e-commerce. But we are very, very particular about maintaining price parity across channels. So we have realized that, getting too worried about salience of channels is not very productive in the medium term. So these channels are growing faster. E-commerce is growing faster than modern trade, is growing faster than general trade. But in fact, we kind of move away from having targets of salience of these.
And last quick question, your earlier company has been doing innovation in the manufacturing in nano factories. I understand that's relevant for small batch size personal care. In your own care, is it relevant or because you're doing a big of 900 crore years, but from a nano perspective, what's your thought process?
I mean, look, definitely the need of GCPS CapEx has to be more automated, larger lines, internet-enabled lines, more productive factories. I mean, our strategy has been to simplify SKUs, growing categories with larger SKUs. And I don't know about other companies, and it's not necessarily true about all categories and all companies, but our game is category development through fewer SKUs. So we really want to get, scale production at the lowest variable cost. That's what our manufacturing strategy is. It will have to be tech-enabled and pretty high-tech. So I think that is true of all new CapEx, but, we are not in the business of having many small SKUs.
One follow-up I had on Indonesia. So new leadership in place. You have done huge certification there. Modern trade distribution also a lot of work in progress. So here, are you confident that most of the issues are now resolved and next 1 to 2 years it could be growth active on a basis?
Yeah, I think so. I mean, look, I don't know the answer to that. I know that our business is now running really well. I know that we're gaining market share. How Indonesia will therefore grow is anybody's guess. But from what we see, both in terms of macros and what we hear on Indonesia, the nickel boom, etc., does look like this is an economy that, is going to be a fast-growing economy. So if we have the right capabilities in Indonesia, I would bet that this would be certainly a value accretive business to us, probably a growth accretive business as well. I don't know about growth actually, certainly value accretive over the next few years.
My question was on capabilities only. Are most of the issues are resolved?
Yes.
Okay. Thank
you. Minus for participants, please press star and 1 to ask a question. The next question is on the line of Kaustubh Pawaskar from Concall by BNP Paribas. Please go ahead.
Yeah. Good evening, sir. My question is on the consolidated debt. What is the debt on our books now?
So hi Kaustubh, this is Samir here. So I think if you look at net cash, basically, we would be, largely net cash as of June end. I think during Raymond's acquisition, we had called out that, with Raymond's acquisition debt on books, we would be net cash somewhere mid of the year. But I think that has come 2-3 months, beforehand. So to answer your question, we are already, in net cash position. It's marginal number, but still net cash as of June end.
Okay. And the CapEx which we are planning to do of 900 crores, will it be largely funded through internal accruals, or you are planning to take any debt?
I think it will be a mix of both, internal accruals and debt, depending upon what's commercially more viable for us. Also, please remember we were very strong cash from, operations, right, demonstrated over the last couple of years, and we expect that momentum also to continue over the next 2-3 years. So, funding this CapEx over a period of next 3 years should not be an issue as such.
Okay. Thanks.
Thanks.
Thank you. Ladies and gentlemen, our last question for today.
Thank you.
On behalf of Consumer Products Limited, concludes this conference. Thank you for joining us. You may now disconnect your lines.